Hey, welcome back to Mortgage Secrets. Great to see everyone here today again. There are so many types of income out there. Why we think that, we can only use the income come from your job or your business. But that's not necessarily true. According to Fannie Mae and Freddie Mac, there are 20 plus different type of income that you can use to qualify for mortgage. So today I'm going to show you first 5 different type of income that we can use. Let's go. So the first type of income that everybody familiar with is alimony, child support, or separate maintenance. So if you are on the receiving end of this type of income, you can totally use it to qualify for mortgage. The only thing you need to show is the documents that prove that you are receiving it, and it will continue for at least the next 3 years. For example, divorce decrees by the court orders, or some kind of legal written agreement between you and the spouse, or a state document. And a lot of times, some lender might require you to show the bank statement that you are receiving this on a regular frequency, weekly, monthly, quarterly. Second type of income that you can use is automobile allowance. Now, there's a difference between automobile allowance and automobile reimbursement, right? The reimbursement meaning you already spend the money and the company should pay you back to offset the expenses. But the allowance is that the company pay you on top of whatever you're already receiving for your automobile, like gas or thing like that. So the only criteria that require is that you can show either on the written verification of employment that you've been receiving this for at least 2 years, or show 2 years of pay stub. We usually require the latest pay stub of the last 2 years. For example, December 2019 and December 2020. And as long as we can see the year-to-date amount of the automobile allowance, we can average that and use that as additional income on top of whatever you already have. The third type is borrower income. What does that mean? Borrower income is for the situation where the borrower have a disabilities and they have a live-in assistant that receiving money from the state or the federal and then pay back to the borrower a portion for rents and meals. You can use this income only and if only the person who's assisting the disability person live in the same house. It can be primary and secondary home, that's okay, but it have to live in the same house and document the money receiving from the state or whatever the program that you use for this kind of assistance, and we can use that to add it to the additional income that you already have. One of the typical program that this type of income comes from is the Medicaid waiver program, who's pay the assistant to live with disability person to help with the daily normal routine. The fourth type of income is capital gain. A lot of time nowadays we have a lot of day traders or people who investing and making money through all this capital gain over the years. A lot of time, this type of income is considered unstable because it's vary from day to day or month to month or year to year. However, we still can use this type of income when you have been doing this for at least 2 years. When I say 2 years, most of the time it required to be reported on the tax returns of the last 2 years, showing a consistencies of income coming in. So for example, if the first year you only make $10,000, but the next year all of a sudden you make $100,000. It's kind of hard to consider this kind of stable. If you make $50,000 first year and you make $70,000, $80,000 next year, that is a little bit more acceptable than the previous example. However, if you have capital gain for at least 2 years and it show on tax return, we can also use that. Show it to the mortgage professionals and to us, so that way we can help you determine whether this acceptable or not, and maybe this is another way for you to help you qualify for mortgage. The fifth type I want to talk about today is the long-term disability income. This is not the same as the Social Security disability that you might have been received. This is from a settlements or some kind of compensations that you're receiving for the disability status. The requirement for this is pretty simple. You need to have a document stating how much you are receiving, how often you're receiving, and if there's any expirations in the future. Since this is a long-term disability, usually they don't have any kind of expiration for this type of income. However, if you do, we might not be able to use it. But if you don't, then definitely we can use that to qualify for mortgage. In the event that you are in the middle of between converting from a short-term disability to a long-term disability income, the document needs to show how much the new long-term disability income will be, and we will use the long-term income instead of the short one. Generally, long-term disability doesn't have an expiration date. Sometimes they might have a reconsidering valuation date, but that's not considered as an expiration date, so no need to worry about that, right? As long as we have that document, again, to show how much you're receiving, how often you're receiving, and it have no expiration date, we can use this long-term disability income to leverage and qualify you for mortgage. Those are the 5 types of income out of many other types that we're going to talk about in this series. And I hope this information will help open up many options and opportunity for you to become a homeowner. If you find this video beneficial, feel free to subscribe, like, and hit the bell notification so you don't miss out on the future valuable videos. Keep an eye out for the next video about another 5 types of income that we can use to qualify you for mortgage. Thanks for watching. I'll see you in the next video.